Hello everyone, welcome to the second video in the central bank section of the training. This is an important one because we're covering how central banks make decisions, and in order to analyze them, you sort of need to know how they think and how they, obviously make decisions on their policy. So first we have a couple of terms and keywords that are very common. You're going to hear them a lot when you're looking at central banks. So obviously you need to know what they are and what they mean. So some of them are in green and some of them are in red. The ones that are in green means they are together. They sort of go hand in hand. And the ones in red also go sort of together, hand in hand. So, starting off with hawkish. When a central bank is worried about overinflation, so usually inflation above 2% per year, right? That is most central banks' benchmark. Then the central bank is considering to take away stimulus, right? Obviously, to bring back that inflation to that 2% mark. That means a central bank is hawkish, right? So just think, if inflation's high, the economy's booming, right? Prices are rising very fast, then the central bank is obviously going to want to take action to reel in inflation. You could say that is a hawkish central bank, and they're likely going to take away stimulus. And that can come in the form of either taking away quantitative easing, which we'll cover in a second, or raising interest rates, because the higher the interest rates, the less people will borrow money to start businesses or buy things or, anything that people do with loans. So second is the opposite, is dovish. When a central bank is worried about underinflation, so very simple, they're just the exact opposite of each other. When there's underinflation, right? Let's say we're in a recession and inflation is below 2% a year, the central bank is considering to add stimulus, right? To get inflation up. You could say that central bank is dovish, right? So, at the different meetings that central banks will have, if they're saying, it's a dovish meeting, then that means that they were talking about how inflation's kind of low. It doesn't necessarily mean they actually changed policy, like they actually lowered interest rates, for example. They could also just be talking about doing it. They could be considered dovish, and even just talking about doing something can move a currency as well. Next up, QE. It stands for quantitative easing. It's a fancy word for a central bank buying assets and bonds. It's a form of adding stimulus, right? So think of QE as the same thing as lowering interest rates, right? It is considered to be adding stimulus. So that means they implement QE when they are worried about underinflation, right? So these two go together because, it's the central bank is dovish and they add QE when there's underinflation, right? It's in red because I think of it as bad, negative, right? Underinflation usually means it's a recession. Overinflation means there's a boom, right? Obviously, that's a little bit of a better problem to have, to some people. But next up, tighten. What does tighten mean? Well, when a central bank takes away stimulus, either by, again, lessening or removing the amount of QE, or by raising interest rates, they're tightening. It's just like a verb. That's what you call it. They're tightening policy. That's when they think about it. You're tightening up ship. You are removing stimulus. Easing is the exact opposite. When a central bank is adding stimulus, right, because there's underinflation, either by adding or increasing QE or decreasing interest rates, you're easing, right? So essentially, these two are opposites and these two are opposites. So when a central bank is hawkish, they're going to tighten policy. When a central bank is dovish, they're going to ease policy, right? So I hope this all makes sense. QE, they implement when they are dovish and when they are easing policy. So moving on, why do we need to know why they make decisions? Well, as traders, we need to know how they make decisions so we can anticipate a possible policy change, right? If we know they're going to change policy, then that's going to affect the currency, and we can obviously trade off of that. So We can anticipate policy changes and price in and trade an upcoming change in policy. Remember, policy changes heavily affects the price of a currency, whether they are more hawkish, again, that means worried about too much inflation, or whether a central bank is more dovish, worried about too little inflation. So we're going to cover what hawkish and dovish means for the direction of a currency a little bit later, but definitely that will have different reactions on the currency. So just keep that in mind. It depends what they do also that will affect the currency. Not just that they change something, but what the change is, in which direction. More hawkish, tightening, or more dovish, easing. So how do they make decisions? Well, a central bank makes decisions based on overall factors affecting the economy at the moment, right? That could be maybe a trade war. It could be a recession. It could be COVID, lockdowns, right? Whatever is affecting the economy, as well as economic data, right? To show them where inflation's at, where unemployment's at, if they need to change their monetary policy to achieve their goal of 2%, right? So it's really just a combination of these two things, overall factors and economic data. That is majority of how they make their decisions. So if there's a recession, something really bad is affecting the economy, and the data's bad, inflation's low, what do you think they're going to do? They're going to ease policy. They are going to want to add stimulus, right? So they judge the state of the economy roughly every month and a half. Essentially, you could just say every time they have a meeting, that's when they reanalyze, right? And see what has happened geopolitically, economically in that time period, as well as looking at the data to determine if changes need to be made or if they can keep policy the same, right? They don't always change something every meeting. Sometimes they're just in wait and see mode. They're just going to keep it steady and wait until the next meeting or the next meeting or the next meeting if everything is going fine, right? So then when do we trade it? Like I said, they don't always do something. So there is usually only a trading opportunity if things are changing, right? If they are changing policy in some way, either for better or worse, right? Again, better, the economy is booming, or worse, we're in a recession with that country's economy, right? Something needs to be changing in the economy and forcing the central bank to take action to either change policy, tighten it, or change policy, ease, right? If the economy is about the same as it was the previous month, nothing major has happened, the data isn't, crazy, different, then there isn't much we can do in terms of trading in those situations. Now, we can still potentially trade that currency for that country as long as something else, is affecting it. But in terms of a central bank, there isn't going to be a trade there. However, there's enough happening in the 8 major countries that normally there will be at least 1 or 2 central banks doing something or about to do something, right? Out of the major 8 countries, normally at a minimum there's one where their central bank is doing something, and you can trade it, right? So let's talk about cycles, sort of how the process works. So this is now going from a recession to a boom, inflationary, right? Let's just call it inflationary because inflation's rising. So starting off, we're in a recession. That's the point of the lowest interest rates, right? Obviously, the central bank wants the lowest interest rates when we're in the worst shape, encourages people to take out loans, and it's going to be the highest QE, right? The highest asset purchases. Again, remember, that is adding stimulus. Now, as we get more into the recovery, inflation starts rising. They're going to probably start getting rid of some QE, right? Maybe not completely, but they're going to lower their purchases, and they're going to begin raising interest rates. Now, this could be a period of a year or a year and a half. It doesn't happen in a month. So just keep that in mind. And then as, we start recovering, we get even more inflation, then we'll probably get rid of QE altogether and again continue raising interest rates. And then we're in a boom, huge economic boom, inflation's off the charts. Then they're going to raise interest rates even higher to try to keep inflation around 2%. And this is going to be when interest rates are the highest, when we're in a crazy boom. And we have been for a while, because remember, this is a pretty slow process. They're not going to raise interest rates by 5% in 1 month, right? So it's a slow incremental increase in interest rates over time. So this is inflationary, and this is very, very bullish for the currency, right? We'll talk about that in a second. But, when inflation is going higher, that is obviously good. And so when the central bank increases interest rates and gets rid of quantitative easing, every meeting that they do that or hint at doing that is going to be bullish for the currency, and we can price that in and trade that. So when a country's economy is in an inflationary cycle, right? Inflation is rising. The central bank will be trying to raise interest rates to fight back against the inflation, and that is bullish for the currency. When a central bank is hawkish with their messaging, right? When they have a meeting, they release a statement. If they sound more hawkish, if they sound like, hey, interest rates inflation is rising, things are going well, and the inflation is kind of above our benchmark, that's a hawkish statement. They're saying inflation's a little too high, right? That would be bullish for our currency. Even if that meeting, they don't end up, actually raising interest rates, that's still bullish for the currency. So they have such an effect on currencies that even saying they're going to do something, could move a currency 50, 100 pips or more, depending, When they actually tighten, when they're a tightening policy, obviously that is bullish for a currency. When they raise interest rates or get rid of quantitative easing or lower quantitative easing, that is all a form of tightening, and that's bullish. And again, raising interest rates, obviously bullish. So inflationary, when inflation is going up and up, that is bullish for that country's currency, right? Now, on the other end, deflationary. So you can see this arrow. Now we're starting with an economic boom and ending in a recession. So when there's an economic boom, again, that is the point of highest interest rates, and obviously there's no quantitative easing because they're not trying to add any stimulus at this point. They are just trying to lower inflation. When there is less inflation, right, that starts slowing down. Then they start to lower interest rates to try to spark economic activity, bring inflation up. Beginning of a recession, things are getting worse and worse, right? They'll start adding quantitative easing, and they'll continue lowering their interest rates. Again, just adding stimulus, trying to spark economic activity to get that inflation rate up. And then recession, things are at its worst. They're adding more QE and lowering interest rates even more. So again, this is the point of lowest interest rates to try to get back to the 2% mark. So pretty simple. This is deflationary. And again, this could be a process of 5-10 years, right? Think about it. We don't go to recession, to boom to recession in a matter of 1 or 2 years usually. It doesn't happen that quickly. But this is just a, sort of zoomed out view. And, again, they change things very incrementally. So it's not like there's going to be only 3 or 4 meetings that's important. Almost every other meeting or every other 2 meetings for a central bank, they're probably going to change something, and that is something we can trade off of. So when a country's economy is in a deflationary cycle, the central bank will be trying to lower interest rates and once they've added it, increase quantitative easing to bring up inflation, and that is bearish for a country's currency. I mean, just think about it. When inflation is low, the country's heading toward a recession, the economic activity is not very good, unemployment is rising. Does that sound good? No, right? That doesn't sound good. So when a central bank acknowledges that, that's bearish. When they do something to fix that, that means it's reality, then that's bearish, if that makes sense. Right? So when they're dovish, when they're saying, hey, we might need to add stimulus if things get worse, boom, that's a pretty bearish statement that might affect the currency, just them saying that. When they're easing, doing something with policy to ease, that is bearish. When they lower interest rates, that is all bearish. And when they increase quantitative easing, that's all bearish. So deflationary, that's bearish, that's not good. So now okay, if you're expecting a central bank to raise interest rates, when you're pricing in that, now we know to buy that currency against obviously a weaker one. But Now we know to buy that currency. When things are not going good for a country and you know a central bank might end up lowering interest rates or increasing quantitative easing, then you know to sell that specific currency is going to be weak. It's going to be sold off leading up to that meeting. And obviously after the meeting, if it turns out that they actually do that, also, should be bearish for the currency. Anyways, that is it for this video. Just a very nice overview of how and why they make decisions. And it's really not that confusing. Pretty simple stuff, right? Inflation is low. They do something to fix it. Inflation's high. They do something to fix it. One of their main jobs is obviously managing inflation and managing the economy. And so these are the tools that they use to do that. And it's pretty effective. And while doing that, they also have a huge impact on markets. Anyways, guys, that is all for this video. In the next one, we'll be covering more in detail on economic data and, how central banks look at it and how we will look at it to determine if they will be, changing policy, and just clearing up misconceptions about economic data, because there is a lot of them in the trading community. So I will see you guys there.